Hey everyone, and welcome to the Deep Dive.
Today, we're diving into some articles you sent in about tech stocks
Okay.
that are being recommended as strong buys.
For dividend investors.
Right.
These articles focus on three companies.
Okay.
Dell Technologies.
Microchip Technology and T-Mobile.
All right.
And they analyze their potential.
For both growth and steady income.
Now, get this.
We're talking about tech companies known for their growth.
Are now stepping into the dividend game.
Interesting.
And we're going to unpack why that's such a big deal.
Yeah, that's a pretty fascinating shift in the tech landscape.
Traditionally, these companies just pour their profits
Back into fueling growth.
Right.
Not paying dividends.
But something's changing.
Even giants like Alphabet and Meta are issuing their first ever dividends.
Wow.
And NVIDIA just hiked theirs.
By a mind-blowing 150%.
150%. Okay, so this is not just...
Some random blip on the radar.
Yeah.
It sounds like a real trend.
This means the tech sector could become...
A whole lot more appealing.
to folks who want both growth potential.
And that steady income from dividends.
You got it. And that's what makes the...
The three companies that we're looking at today,
interesting.
they each blend growth potential with dividend payouts.
Okay.
A sweet spot for a lot of investors.
All right, let's kick things off with Dell Technologies.
They've had a phenomenal year.
With their stock up over 57% since January.
And a whopping 80% over the past year.
Wow.
What's fueling this incredible run?
Well, Dell has really positioned themselves.
At the forefront of AI.
And the cloud computing boom.
They're not just about laptops anymore.
They're supplying the critical infrastructure for the future.
And the market is definitely taking notice.
And their latest earnings report totally backs that up.
Over $25 billion in revenue for Q2.
A 9% jump from last year.
That's driven largely by strong sale.
Of servers and networking equipment.
Plus, they crushed analyst expectations.
For earnings per share.
But here's where things get really interesting.
Dell's forward price to earnings ratio.
Or forward PE sits at 15.31.
Now, for anyone unfamiliar with this metric,
it essentially helps us gauge
if a stock is overvalued or undervalued.
Relative to its expected earnings.
Okay.
And in Dell's case,
their forward PE is significantly lower
than the sector median of 24.2.
So even though they're killing it performance-wise,
the market might still be underestimating their potential.
That sounds like it could be a good thing for investors.
Exactly.
Looking for value.
And let's not forget the dividends.
Dell's offering a 1.48% yield.
With a quarterly payout of 0.445 cents per share.
They've also been steadily increasing their dividend payouts.
For the past 3 years.
So they're putting their money where their mouth is when it comes to rewarding shareholders.
Plus, they're going all in on AI innovation.
Expanding their AI factory with new PowerEdge servers.
And teaming up with NVIDIA on the Dell AI for Telecom program.
They're not just riding the AI wave.
They're actively shaping it.
This explains why analysts are so bullish on Dell.
14 out of 19 rated a strong buy.
With a potential upside of 22.6%.
Wow.
Now let's switch gears.
And talk about Microchip Technology.
Oh.
Their year has been a little different.
Their stock is down about 16% in 2024.
Interesting.
Why is Microchip's performance lagging behind Dell's?
Especially during this tech boom.
Well, Microchip's focus is a little different.
They specialize in what they call
smart, connected, and secure tech solutions.
Things like microcontrollers,
analog chips, and FPGAs.
They cater to a wide range of industries.
From automotive to telecommunications.
So they're more behind the scenes.
But providing the fundamental building blocks.
For a lot of critical technologies.
Exactly.
Kind of like the unsung heroes of the tech world.
And despite their stock's recent dip.
They have a forward PE ratio of 37.89.
Which is higher than the sector median.
This tells us that investors are still willing to pay a premium.
For their stability and reliable performance.
And let's not forget about their attractive dividend yield.
Of 2.41%.
Plus, they've consistently increased their dividend.
For an impressive 23 years straight.
That's right.
They're on track for what's called dividend aristocrat status.
To achieve this, a company needs to be included
in the S&P 500 index.
And have a track record of at least 25 consecutive years.
Of dividend increases.
Wow.
It's a coveted title.
Among income-focused investors.
So, a bit of a bumpy ride for Microchip this year.
But they seem to be focused on the right areas.
For long-term growth.
They are.
They're busy expanding their Wi-Fi portfolio.
With 20 new products.
And collaborating with Acacia on high-capacity optical transport solutions.
And while their recent Q1 fiscal 2025 results were mixed,
analysts are still optimistic.
15 out of 22 rated it strong buy.
with a potential upside of about 23.6%.
Now onto our third contender.
T-Mobile.
They've been absolutely crushing it.
Their stock is up a staggering 65% in the past year.
And over 45% year to date.
Wow.
What's behind this incredible surge?
Their Un-carrier approach
With its emphasis on affordable, high-quality wireless service.
seems to be winning over customers left and right,
It definitely makes you wonder.
if those flashy ad campaigns are actually paying off.
But with a forward PE ratio of 23.1,
Higher than the sector median.
are they possibly overvalued?
That's a great question.
And one that investors are grappling with.
While their PE is high,
Their PEG ratio, which factors in expected earnings growth.
sits at 1.03
This suggests that there might still be room.
for them to grow.
And let's not forget, they're relatively new.
To the dividend game,
Right.
they're currently offering a 1.61% yield.
With quarterly payments of 65 cents per share.
It'll be interesting to see how they develop their dividend policy.
As they mature in this space,
The Q2 financials were truly impressive.
revenue reached nearly $20 billion,
A 4% increase from last year.
driven by strong post-paid service revenue growth.
Plus their net income and earnings per share,
Both saw significant jumps.
up 32 and 34% respectively.
Wow, those are some serious gains.
And it doesn't sound like they're slowing down anytime soon.
Not at all.
They're aggressively expanding their 5G network.
Through strategic partnerships.
For example, they recently teamed up with TCL
To launch the TCL LinkPort IK511.
for 5G connectivity.
It seems like every time I turn around.
There's a new 5G device popping up.
But T-Mobile's ambitions go beyond just phones, right?
Absolutely.
They're all about connectivity across the board.
Their introduction of 5G on demand
A portable private network solution
shows that they're serious about bringing 5G.
to a wider range of industries.
So they're not just about connecting people.
They're connecting businesses and industries as well.
Smart move.
Analysts are definitely on board.
18 out of 25 rate T-Mobile a strong buy.
With a potential upside of 16%.
It's incredible to see how these three companies,
Each with their own distinct approach,
and recent performance,
are attracting so much attention
for their potential.
as both growth stocks and dividend payers,
It's a testament to how the tech sector is evolving
become more appealing.
to a wider range of investors.
But before we get ahead of ourselves,
I need to dive into some of the challenges these companies face.
no investment comes without risk.
And understanding these risks
It's just as important.
as understanding the potential rewards.
That's right. Stick with us as we continue to explore
These investment opportunities.
in part 2 of our deep dive.
Welcome back to the deep dive
We just explored the impressive growth and dividend potential.
of Dell, Microchip, and T-Mobile.
But as with any investment, it's crucial to understand the risks and challenges.
Before jumping in,
So let's dive into that now.
that's a great point,
It's easy to get swept up in the excitement,
of high growth stocks.
but smart investors always consider the potential downsides.
So what are some of the headwinds these companies might face
Well, for Dell, one of the biggest concerns is the overall health.
of the PC market?
Global PC shipments have been declining for several quarters.
And that could put pressure on their core business.
While they've been strategically shifting their focus,
To enterprise solutions and services,
the consumer PC market still represents.
a significant portion of their revenue.
That's true. They can't just ignore the consumer market.
It seems like they're in a bit of a balancing act,
Trying to maintain their position in the consumer market?
while simultaneously expanding into new high-growth areas.
Exactly. And they're also facing fierce competition.
You're constantly battling with rivals.
Like HP, Lenovo, and Apple.
Not to mention the growing presence of cloud providers
Like Amazon Web Services.
and Microsoft Azure.
It's a tough market to be in, that's for sure.
It seems like constant innovation is key.
And Dell's aggressive push into AI.
Could be the right move. But as you said,
It's a race with no finish line.
absolutely. Now, for Microchip, one of their biggest challenges,
Is managing their supply chain.
semiconductors are in high demand, and any disruptions to their supply of raw materials
Or manufacturing capacity.
could impact their ability to meet customer needs.
Oh, that's right.
We've seen how supply chain
And
issues,
then wreak havoc on businesses.
especially in the tech sector,
Do you think the ongoing global chip shortage?
is a major concern for them.
It's definitely something to keep an eye on.
They've been actively working,
To mitigate these risks.
but it's a complex and dynamic situation.
Another concern for Microchip is
Their relatively high debt levels
they've made some strategic acquisitions in recent years,
to expand their product portfolio.
but that's also increased their debt burden.
Debt can be a double-edged sword.
It can fuel growth, But it can also become a burden.
especially if interest rates continue to rise.
Or if their business slows down.
How are they managing this debt
They've maintained a strong cash flow.
and are actively working to reduce their debt?
But it's something that investors should be aware of.
Now let's shift gears and talk about T-Mobile.
One of their biggest challenges.
Is fully integrating their acquisition of Sprint.
Ah, yes, that was a big one.
Didn't it take them years?
To get regulatory approval for that merger.
It did.
And while the mergers was completed a few years ago,
They're still working to combine networks and systems.
which can be complex and costly,
They're also facing increased competition,
from their rivals, Verizon and AT&T,
who were both investing heavily in 5G.
and expanding their own service offerings
It's a constant battle for market share.
in the wireless industry.
It seems like they all have those catchy ad campaigns.
And unlimited plans.
How can T-Mobile continue to differentiate themselves?
They've been successful with their uncarrier approach.
But maintaining that innovative edge will be crucial,
They need to keep finding ways to deliver value to customers.
whether that's through pricing, network coverage.
Or unique features.
Another potential concern for T-Mobile,
Is their exposure to regulatory scrutiny?
the wireless industry is heavily regulated.
And any changes to regulations or policies?
Could impact their business
That's true. We've seen how government policies,
and have a significant impact on industries.
and the telecom sector is no exception,
Right. A few years ago, there was talk,
of breaking up some of the big tech companies.
including those in telecom.
Well, that hasn't happened yet.
It's a reminder that the regulatory landscape.
Can shift quickly.
So while all three of these companies,
Have a lot going for them.
they also face some significant challenges
It's important to weigh these factors carefully.
when considering them for your portfolio.
I couldn't agree more.
It's all about balancing potential rewards with potential risks.
And speaking of risks,
There's one more crucial aspect,
we need to consider,
the macroeconomic environment.
after all, these companies don't operate in a vacuum,
Global economic trends can have a significant impact.
on their performance.
That's a great point.
We've been talking about these companies in isolation.
But things like inflation
Interest rates
and even geopolitical events
can create both opportunities and risks.
for investors.
Absolutely. So in part 3 of our deep dive,
We'll explore how the current macroeconomic
it
landscape
might affect the prospects.
of Dell, Microchip, and T-Mobile.
Stay tuned.
Welcome back to the deep dive.
We've covered a lot of ground,
Right.
exploring the potential of Dell, Microchip, and T-Mobile as dividend plays,
We've looked at their growth
their strategies.
and even the challenges they face.
But there's one more layer we need to peel back,
Yeah,
the impact of the broader economic landscape.
that's right, because these companies
Don't operate in a bubble.
right,
Global economic trends,
can act like a tide.
lifting all boats or pulling them under.
And right now,
Those currents are particularly strong.
we've got inflation that's still sticky
Interest rates on the rise.
and geopolitical uncertainty adding to the mix.
Okay, so how might all of this impact?
Our three tech contenders.
Let's start with inflation.
Rising prices can squeeze profit margins for companies.
If they can't pass those costs along to consumers,
This could be a challenge,
for a company like Dell,
which operates in a super competitive market.
where people are pretty price sensitive,
But on the other hand,
Dell also has that strong enterprise demand
and businesses might be more willing to absorb price increases.
compared to individual consumers.
Yes.
It's a bit of a balancing act for them.
Now let's talk about rising interest rates.
This can impact businesses in a few ways,
It can make it more expensive for them to borrow money.
which could put a damper on their growth plans.
It also makes bonds.
And other fixed income investments more appealing to investors.
It's potentially pulling money away from stocks.
So higher interest rates could create a bit of a headwind,
For all three companies,
especially those carrying more debt.
like Microchip,
Right.
as we discussed earlier,
Precisely. And then there's geopolitical uncertainty.
which can throw all sorts of curveballs.
Businesses.
We're talking disrupted supply chains.
Increased volatility in currency markets.
You name it.
It's like trying to hit a moving target.
When the whole world is in flux.
And all three of these companies have global operations.
So they're definitely exposed to these risks.
That's right.
Think about it. If a company manufactures components overseas,
And suddenly there's political instability in that region.
their entire production process could be disrupted.
Okay, so given all these macroeconomic factors swirling around,
What's the bottom line for investors?
should they be hitting the panic button?
Or doubling down on tech stocks?
It's not about panic or blindly doubling down.
It's about understanding your own investment goals
Your risk tolerance.
and your time horizon.
If you're a long-term investor,
with a diversified portfolio.
these macroeconomic headwinds might not be a major concern.
In fact,
They could even present some buying opportunities.
that's an interesting perspective.
It's like that saying,
Be fearful when others are greedy.
and greedy when others are fearful.
Exactly.
Market downturns can be nerve-wracking.
But they can also be a chance to buy high-quality companies at a discount
But of course,
if you're more risk-averse.
or have a shorter investment horizon.
You might want to be a bit more cautious.
So no easy answers.
Just smart considerations.
It all comes back to doing your homework.
Always.
Understand the risks involved.
Consider how these macroeconomic factors might play out.
And most importantly, don't invest more than you can afford to lose.
Solid advice.
So where does all of this leave us?
With Dell, Microchip, and T-Mobile,
Well, despite these macroeconomic headwinds,
all three companies still have a lot working in their favor.
Dell is well positioned in the growing enterprise technology market.
Microchip offers stability and a long track record of dividend growth.
And T-Mobile is a leader in the rapidly evolving wireless industry.
It seems like they each have a unique story to tell
A unique set of strengths.
and a unique set of challenges.
Absolutely.
And for investors,
It's about figuring out which story aligns best.
with their own investment philosophy and goals.
Oh, well said.
And that wraps up our deep dive into these three compelling tech stocks.
As always,
We encourage you to do your own research
consider your individual circumstances.
and never stop learning.
Thanks for joining us on the Deep Dive
We'll be back next time with another deep dive.
into the world of investing.